afternoon. On behalf of Infomerics Rating and on my own behalf, it's my pleasant privilege to welcome you here once again. We are thankful for the kind of excellent response we have received from a wide cross-section of society, bankers, central bankers, academia, and even well-informed common man. Now we've decided to call this series Reading Between the Lines, because what we propose to do here is twofold. One, we look at the big picture, but what is equally important is the fact that while looking at the big picture, we would not be in any way oblivious to ground level realities, to disaggregated data, granular data. So this edition of Reading Between the Lines focuses on the position of the NPAs, non-performing assets, in the banking system and the efforts by the banks to address this serious issue. Let me try to put this issue in a proper perspective. Of late, the Indian banking system has been in the news for all the wrong reasons. There have been several high-profile cases, far too numerous to name here, but then let me refer to the cases of Vijay Mallya, Nirav Modi, Mehul Choksi, Winsome Diamonds, so many of them are there. And all these have decidedly brought a bad name to the banking sector in particular. Now, the position of NPAs in the Indian banking system also needs to be placed in a proper national and international perspective because of the ravages, because of the devastation caused by COVID-19. COVID-19 has sometimes been compared to the global financial crisis of October 2008 and even the Great Depression of 1929. While assessments vary, there seems to be a fair measure of consensus that the present situation in the wake of COVID-19 is even more weak. The crisis is more severe in its wide-ranging repercussions and ramifications across the board. We do not wish to do any data crunching, but let me refer to two important studies which were placed in the public domain by the World Bank and the IMF. The World Bank's forecast of global economy believes that the global economy could shrink by 5.2% this year. Similarly, the IMF, the International Monetary Fund, maintains that this year we could have a shrinkage of something of the order of 4.4%. Now, to place matters in perspective, at the global level, this would be the deepest recession since World War II. If we look at the position of emerging market economies, what we find is that the banking system across the development spectrum has taken a major crippling hit. And there have been some studies done at the level of various multilateral institutions, at the level of individual countries. Also, we have some kind of a strong anecdotal evidence, and all that suggests that the banking system of India, Mexico and South Africa will be relatively slower to recover to the pre-COVID-19 levels. In fact, there are some estimates which suggest that the process of recovery of the banking systems in India, Mexico, and South Africa could go well beyond 2023. Now, all of us are aware that we in India are in this process of an unlocking of the Indian economy. But it is disconcerting to note that India's animal spirits remain fragile despite this process of unlocking. To be sure, there are positive factors such as negative interest rates in major markets, huge forex reserves, which seem to surge from one peak to another, ample liquidity in the banking and financial sector, and surging foreign direct investment, popularly called FDI. But the flip side is that there are persisting issues of high unemployment rate, stress debt seems to rise, there is no investment cycle in corporate credit, consumption engine continues to be weak and faltering, and balance sheets of banks are also quite weak and not adequately robust. Now, if we look at the macroeconomic position, there are several issues of major concern here. The Q1 numbers which were out, first quarter numbers for April-June 2020 gross domestic product, that those figures revealed a contraction, a shrinkage of 23.9%, and for the full year we could have a contraction of something of the order of 8 to 10%. COVID cases continue to spike, businesses continue to limp, there are issues of disrupted supply chains, demand destruction, free fall in investment, debilitated consumption demand, low corporate credit appetite, job losses, and salary cuts across the board. The weak and unsatisfactory position of the banking system has evoked considerable debate and discussion in the development discourse. But it is our submission that the banking sector is a microcosm, is a miniature model of the Indian economy. So when at the macro level you have such serious and severe issues, obviously they should to a certain extent find a reflection in the banking sector. Some of the major issues plaguing the banking sector today relate to modest capital buffers for most public sector banks, the issue of high and mounting levels of non-performing assets, NPAs, higher credit costs, weaker earnings because of interest reversals, and lower fee income, also subdued growth prospects. When we discuss the issue of NPAs in the banking sector, sometimes we tend to be simplistic and not look at the issue in all its facets and dimensions. It's important to realize here that SCBs, scheduled commercial banks, popularly known as the banking industry, is not a monolithic category. Accordingly, it would perhaps be fair and reasonable to maintain that one size does not fit all. There continue to be significant differences across public sector banks and private banks, and even within these two groups. But on the whole, there seems to be little doubt that private banks are better placed to withstand post-pandemic pandemic challenges. Since March 2020, the Reserve Bank of India has reduced the repo rate by 115 basis points and reverse repo by 155 basis points. Banking system continues to exhibit systemic position of surplus liquidity. But some of the major features of the banking sector today relate to low demand, increased banks reversion, risk aversion. All this have contained the growth of credit. There continues to be low CD ratio, credit deposit ratio, negative bank credit across sectors, decline in major industries credit, also a serious downturn in retail and microcredit. Despite the Government of India's series of stimulus packages and the Reserve Bank of India's liquidity measures to reduce counterparty risk or credit risk of loan transactions and thereby minimize the potential of systemic risk of a banking crisis, there seems to be little doubt that there could be increased loan defaults and delinquencies. Besides, the Reserve Bank of India's moratorium facility for all term loans, lenders have also on their own proactively restructured loans to reduce the cash flow burden in the near term. All this is welcome, but we do maintain that more efforts are required because of the widespread pain across segments, across sectors of the Indian economy. In this kind of an emerging economic scenario, banks should prepare for losses and build capacity to deal with increased delinquent loans. In this phase of unlocking, banks need to repurpose, refashion their go-to-market and customer acquisition model because of transforming consumer behavior. One aspect of the banking sector which needs to be highlighted today is the fact that there is a severe squeeze on profits and profitability, and revenue compression has emerged as a serious issue across various segments of Indian banking. This is primarily because revenue from retail and commercial banking is falling sharply because the underlying consumption and transactions have dipped steeply. With central banks across the world slashing interest rates, banks are reducing yields to generate business, thus significantly reducing net interest margins, which are popularly called NIMs. Income from payments and other fee-based services has also been hit by a discernible macroeconomic slowdown, and the kind of slowdown, kind of a contraction we are looking at this year, as I said earlier also, maybe something in the order of 8 to 10, 11% would be first such contraction in 41 years. So when we have a GDP shrinkage, a contraction of this magnitude, obviously it will find a reflection in the functions and working, in the bottom line, in the levels of profits and profitability of the Indian banking system. There have been also issues of measures like moratorium on loans, which have reduced banks' cash flow. We have done some kind of a rough approximation, back of envelope calculations which suggest that there could be a drop of up to 10% in banks' payment revenues. In this kind of a scenario, where the issues of social distancing, wearing of masks, other things have come increasingly into focus, banks need to focus on making payments safer by increasing limits on contactless payment channels and stress digital products. There is also a scope for much closer coordination, engagement with the Reserve Bank of India to contribute towards required policy changes. Banks need to optimize their network, optimize number of operating branches, ATMs, redeploy staff based on the government's mandate and footfall, maintain optimum liquidity and credit deployment given changing rates and bond yields. Banks must assess vulnerabilities and identify strategic risks based on exposure to each sector, geography before providing loans. Now let us come to the basic issue of high and mounting levels of NPAs. But as I said earlier also, it would be simplistic, it would be unrealistic to maintain that one size fits all. One size does not fit all, and accordingly NPAs are not uniform either across bank groups or across sectors. Now in this connection, let me briefly highlight some of the major findings of the Reserve Bank of India's Financial Stability Report, popularly called FSR. Some of you may be aware that this is an important biannual publication of the Reserve Bank of India and has been so for the last possibly 7-8 years. They publish it twice a year in June and December usually, but this time I think the last issue was brought in the public domain on July 20. In this latest FSR, Financial Stability Report, the RBI has given their findings for its stress testing for 53 scheduled commercial banks, and they have forecast that GNPAs, gross non-performing assets of all scheduled commercial banks, could rise from 8.5% in March 2020 to 14.7% under a severely stressed scenario. Even in terms of a baseline scenario, this is expected to rise from a level of 8.5% in March 20 to 12.5% by March 2021. The RBI has highlighted 3 scenarios depending on the kind of hit, the kind of situation which pans out in this financial year. In this kind of worsening macroeconomics, private banks' loans could rise from 4.2% in March 2020 to a level of 5.7 to 6.4% by March 21. What is of greater concern is that the NNPAs, net non-performing assets, could rise from 4.2 to 4.3% for PSBs from the present level, from the March 20 level of 3.3%, and in case of private banks, it could rise from 1.2 to 1.4 to 1.7%. 5 to 8% of the outstanding loan book could also be restructured. I have highlighted some of these important figures because these must be considered for any objective and comprehensive examination of the NPA system in the Indian banking today. I am reminded of some very famous lines by a well-known Hindi poet, Dushyant, and I quote Dushyant when he wrote powerfully, and I quote, मेरा मकसद नहीं है हंगामा खड़ा करना, मेरी कोशिश है ये तस्वीर बदलनी चाहिए. For those of you who may not be fully familiar with the Hindi language, let me attempt to give some kind of a rough English translation which could go something on these lines. It is not my purpose to create a scare, but my firm resolve is that things should change and change for the better. On the whole, most NPAs are now recognized, but there could be some more slippages going ahead. Things could get worse before they get any better. But if we look at various segments of the loan book, we feel that there could be surge in retail and MSME NPAs. Several infrastructural projects may not also do very well, and obviously this could lead to higher NPAs in the infrastructure segment also. Now we have tried to look at some of the basic causes of the surge in NPAs. This analysis is based on both primary and secondary data. We have looked at published reports of the Reserve Bank of India, Government of India. I had the occasion of working in leading banks and development financial institutions for well over 30 years. Also some kind of an anecdotal evidence, discussion with bankers, borrowers, and even people at the helm of affairs. So on this basis, because this surge in NPAs has been an issue which has been considerably debated and discussed in the development discourse in general and the banking system in particular. So what we propose to do here is to cut the clutter, and we propose to cut the clutter here and then highlight some important issues. First, as I said earlier, there is the issue of macroeconomic slowdown and contraction of GDP. So this issue also has some kind of a bearing in the rise of NPAs across the board. Another factor to our mind is the high credit growth in some sectors, which led to decline in credit quality subsequently. There are issues of pre-sanction deficiencies and ineffective post-disbursement supervision, deficient credit monitoring. Another unpleasant and unfortunate aspect of the rise in NPAs relates to high incidence of frauds, and we have done some kind of analysis here. Maybe possibly we could go into that at a later stage, that most of the frauds in the banking system, some anecdotal evidence would place it at possibly 80% or so, relates to advances frauds. This is due to a variety of reasons: faulty credit appraisal, deficiencies in pre-sanction appraisal, post-disbursement supervision not adequate. In some cases, there could also be collusion between the bankers and the borrowers. Another important issue contributing to the surge in NPAs relates to high level of leverage of corporate borrowers, credit growth, diversification of funds, substandard assets and frauds, all these issues are strongly correlated. In fact, it has sometimes been maintained that these issues of leverage of corporate borrowers, credit growth, diversification of funds, substandard assets, and frauds are first order derivative of improper credit and recovery management. Another strand which I wish to highlight is the issue of moral hazard of identifying business failures as frauds. Some cases, deficient credit appraisal is not properly looked at, and there are also issues of fixing of staff accountability, due diligence. All these issues also come into play. As things stand today, the issue of resolution of NPAs is an issue of utmost concern. This must receive overriding and paramount significance. Some preventive measures to avoid slippages could relate to effective monitoring of accounts right from the time of sanction, prompt recovery of installments and interest by regular contacts, reminders, recovery of critical amount, refacement, restructuring if required, timely renewal, regularization of credit limits. However, if despite all these measures the account does slip, then there could be measures for upgradation of accounts by recovery of overdues, restructuring, rephasing of accounts as per the stipulated guidelines. Seizure of hypothecated goods becomes important when the account becomes NPAs. An attempt should be made to seize the goods by issuing 15 days notice. Branches must inspect all collaterals, obtain valuation when the account becomes SMA2, special mention account 2, ensure recovery steps on account becoming NPA, compromise settlement in conformity with RBI norms and guidelines also needs to be looked at. Some of the non-legal methods, because in NPA resolution all bankers are agreed that both legal and non-legal methods must be pursued with a sense of urgency. So in case of non-legal methods, we'd like to highlight regular contact with borrowers and persuasion, branches to contact NPA parties and to bring the parties for OTS, one-time settlement, upgradation, resolution of account. Most banks have been using the recovery agents quite effectively in the last 10-15 years, and there is a rough norm which suggests that rule of thumb that there could be 5 to 6 recovery agents per district to contact all small value borrowers for recovery and resolution of the account. Seizure agents need to be entrusted with the seizure of vehicles immediately when the accounts become NPA or SMA2. Some other important measures for NPA resolution in case of by way of non-legal methods relate to the issue of willful defaulters, which has been plaguing the Indian banking system for a very long time. In case of willful defaulters, there must be immediate identification when the account becomes NPA. There has to be a time-bound process under the SARFAESI Act which could yield recovery either by OTS, upgradation, or disposal of property. To provide an impetus to this process of recovery, banks could empanel more SARFAESI agents to take physical possession of the properties immediately. Sale of assets successful only on physical possession of the properties. Action under the SARFAESI Act is important, and for real and effective action, there need to be SARFAESI cells at all controlling offices to monitor the prescribed timeline for issuing notices, follow-up action. SARFAESI cell should also maintain the list of all eligible SARFAESI accounts by contacting branches, and they should generate daily slippage account more than of an amount of 1 lakh or more liability. Demand notices need to be issued in case the account is not upgraded within a fortnight by collecting all the EMT papers and the details of security. In case the account is not upgraded within 60 days on notice service, possession should be taken within 1 week and valuation taken simultaneously. Publication of possession notice and also issuance of sale notice immediately after taking possession, duly fixing the reserve price, is an important issue here. Another issue which emerges is the purchase of non-banking assets. Towards this end, it is necessary to identify properties under physical possession, but sale could not be done due to indirect party intervention. In some cases, it could be purchased by the bank in case of failure of auction for at least 2 times by bid submission. This non-banking assets can become a banking asset also if the property is deemed to be useful for the bank. Otherwise, this property could be disposed of within a period of 7 years. NCLT and IBCs are important in case of parties conducting business but avoiding dues to the bank. Recourse could be made by banks to these. Now, sale of assets to asset reconstruction companies where banks find difficulty in removing accounts immediately from bank books. Appointment of business resolution agent to resolve accounts through close monitoring by SARFAESI compromise. Filing of DRT suit. Detective agents appointment by all zones and circles to a certain net worth. Interim application for appointment of advocates to take inventory, valuation of stocks, machinery, while filing DRT suit to avoid pilferage, erosion of valuables. In case of a closed unit, the bank can pray for disposal through court. Immediate steps also need to be taken by all banks for execution of decree or recovery certificate. Now, where do we go from here? It is obvious that COVID-19 will have an enduring impact across the industries, including banks. And this kind of a evolving economic landscape, banks need to be adequately secured with their assets, qualitatively strong and amply capitalized. In this kind of a new normal, it has to be realized that size is essential, but efficiency is even more so. So there has to be some kind of a paradigm shift from transaction based to business oriented. But the kind of risk aversion we find today in the banking system, because high and performing levels of NPA, maybe that is also not a desirable thing, and remaining overly risk averse could be self defeating. In terms of Section 5B of the Banking Regulation Act, one of the basic purposes of the bank is accepting deposits for the purpose of lending. So lending has to be the bread and butter of the banking system. So banks need to strike the right kind of balance between prudence and prudent lending and considering all factors holistically. The issue of a proper and an effective risk management system also becomes important in detecting vulnerabilities and capturing of risk with changed external environment and best practices. Risk management could help to manage operational risks, particularly controlling frauds, both cyber related and otherwise. An effective early warning system and forward looking stress testing framework could also be helpful in dealing with this issue of NPAs. We'd also like to stress appropriate compliance culture, transcending legal binding within the broader standards of integrity and ethical conduct. Let me here briefly refer to the example of Habib Bank, which is Pakistan's largest commercial bank, and some of you might recall that in case of Habib Bank, the US Fed, the regulator in the US, had imposed a hefty penalty of $225 million about 3 years back. So this kind of heavy penalties work as something like a double whammy, in the sense that when the bottom line is not all that well, when there are pressures on profits and profitability, any outgo by way of regulatory penalties will dent the bottom line still further. But this is one part of the story and a minor part of the story. To my mind, the other and the more serious part of the story is the damage it could have on what is known as reputation risk of the banks. Most of us are aware that these days banks are subjected to a variety of risks which are usually referred to as credit risk, market risk, operational risk, interest rate risk, sovereign risk. But perhaps the most severe risk which could completely devastate the banking sector is the risk of reputation risk. Because if God forbid, if there's a run on the bank, there have been very comprehensive exercises done across the countries which clearly bring out, unmistakably bring out, that if there's a run on the bank, possibly no bank could survive anywhere for more than 30 to 45 minutes. So this issue of reputation risk, which is close related to the compliance issues, also needs to be looked at. Going ahead, there are the issues of a good governance framework, effective risk and compliance culture with a strong internal audit and inspections. Banks could be proactive in building buffers and capital raising. banks, NBFCs need to assess the impact of COVID-19 on their balance sheet, asset quality, liquidity, profitability and capital adequacy for mitigation measures, aspects such as capital planning, capital raising and contingency, liquidity planning, etc. Now let us come to our concluding remarks. Post this COVID-19 crisis, digital maturity and COVID-19 resilience will determine the strategy of banking players. We see three distinct banking segments emerging. One, banks which are already future ready with truly digital banking capabilities and cost elasticity. Now this, as I said earlier, will have a reflection across the entire line of functions and working of commercial banks. But even if I find myself here to the issue of asset quality or non-performing assets, then digital capabilities could help in effectively managing loan recovery processes with systematic workflow, early warning signals to flag NPAs, analysis of repayment capacity to offer flexible payment choices. Digitalization could help in proper root cause analysis for NPAs, implement required changes in credit policy, product promotions, etc. The use of digital tools could also be helpful in an analysis of quick mortality loans, automatic contact process for consistent follow-up. It could provide an analytical dashboard with complete customer 360-degree details. There could be a greater use of artificial intelligence, machine learning and predictive analysis. But in some tech-savvy banks, we find that the fraudsters are one step ahead of the bankers. So there has to be a greater thrust on fraud detection and risk management, know your customer and anti-money laundering processes, systems of the bank. The second set of banks, which are digital laggards, they need to evolve and renew due to subpar COVID-19 resiliency. Banks which are at the bottom of the technological pyramid will struggle to survive as a result of being digital laggards with subpar financial and operational resilience. Given the kind of situation that we are in today, there have to be coordinated and concerted measures with a sense of immediacy to reduce the stock of outstanding NPAs and credit premia and also improve overall accessibility of bank credit. These are difficult times, times of great turbulence, times of great challenge, a time perhaps like no other in this century. But the Indian people and the banking system has always displayed immense dynamism and resilience. We see no reason why this time it could be any different. We shall overcome. This too shall pass. Thank you all very much. Thank you for being with us here this afternoon.